Good morning and welcome to Managerial Accounting. As always, we'll start with a look at our calendar. So the annual report project is due today. However, if you submitted a draft, I have not gotten through all of those yet. So if you submitted a draft last week, you don't need to worry. Once I get through those, and my goal is to finish those today, you will have adequate time to make any adjustments that you want to make. So I know people are concerned about that, and rightfully so. I did expect to get through them last week, and that just did not happen. So I'm continuing to work on those. As I said, I hope to get through them today, and then you will not have to turn around any edits today. So please don't worry about that. I will include that in the announcement after class today as well. If you did not submit a draft last week, though, your project should be submitted today by the end of the day. Then we finished chapter 24 last class. So chapter 24 problem should be submitted today, and we'll be starting chapter 25. So as always, the pre-quiz should also be submitted for grading today. 60% or higher to get full credit on that. So looking at our calendar, just as a reminder, I know you all know this and you're probably eagerly anticipating this. We are covering chapter 25 this week. When we finish chapter 25, we will be done for the week. So it very well may not take us the full 2 class periods to do that. When we finish about half of the half of the chapter today, I will ask, do you want to keep going or do you want to have a shorter class today? Because again, I would anticipate that this chapter in particular will not take us 2 full class periods. There's absolutely no reason for us to move ahead, because as we look forward on the calendar, everybody knows we're on break next week, I assume, leading up to Easter. Chapter 25 is the final chapter on our next exam. So there's absolutely no reason to move ahead of our schedule and start chapter 26. So be thinking about this as we work through the chapter today. Once we finish half of the chapter, I'll be asking, what do you want to do? Keep going or call it a day? All right, so once we get back from the break, your chapter 25 problem will be due, and then you can take the exam. As I suggested last week, if people want to just get that out of the way, not have to think about it at all over the break, after we finish chapter 25 this week, you're welcome to go ahead, do the problem, do the exam, and then set accounting aside until we get back on the 19th. So the exam is open. You're really welcome to take it whenever works best for you. If you want to wait and take it, excuse me, on the 24th, you can do that too. But it is really completely up to you what works best for your schedule, for your peace of mind. JP. No. So the exam, so the question was, will we have finished all the material? And the answer is yes. Everything that's on the exam is through chapter 25. So it's 22, 23, 24, and 25 are on the exam. We're finishing 25 on Thursday. The only reason the exam is after the break is because the chapter 25 problem isn't due until after the break. So if you want to move things ahead, do the chapter 25 problem after we finish the chapter on Thursday, and then take the exam before the break, you're welcome to do that. But yes, we will have covered everything that's on the exam by the time we finish class on Thursday. Any other questions about what's coming up?
I have a question, Cindy. My computer died at the end of class, so I didn't get to finish the chapter 24 exercise. And I went to look at your video, but the video that's in there under chapter 24 only goes to exercise like 5. So there's no recording for the rest of that class, like a conclusion.
There definitely is one, but okay. Yep, so let me just get it in there.
Thank you.
And if that happens again, so obviously that's an oversight. Sometimes it takes, so sometimes it takes YouTube a little while to get those videos ready. And if I get doing something else, if I have meetings or whatever, I get sidetracked and I forget that it's not in there. So, and since we're doing this, I'm going to go make sure it's in the other class as well, because I'm going to guess if I didn't put it in this class, I didn't put it in the online class. Yeah. So, but if that does happen, they're always available on YouTube. If you just go to YouTube and search Business 1520 and the chapter number, you will find it there.
Okay.
You just want to probably make sure that you're pulling the right. So now I label them all with the semester. When I first started doing this, I didn't necessarily label them. So you want to just check the date or check the date that the video was uploaded to YouTube. We'll also make sure you're getting the right one. The assignments are basically the same from one semester to the next, but the way they get broken up, so then the exercises we do on a specific day could change. So thank you, Jamie, for letting me know that, because that certainly was not intentional. And the link is there now. And
Thank you.
and as always, if you need more time to get those done, then that's perfectly fine. So just take the time that you need to be able to go through the rest of that video. Anything else you want to talk about? Anything from chapter 24 or 22 or 23 before we start the new material? All right, yeah. We will move right into the new chapter. So our chapter for this week is Differential Analysis and Product Pricing, chapter 25. I didn't go through the whole calendar for after the break, other than reminding you about the exam, but we have basically 3 weeks of class left after the break. This is a really late break because Easter being so late this year. So after the break, we'll be covering a chapter a week, 3 chapters, and then the last exam will be due the last week of the semester, and that is on just those 3 chapters. So as you know, we have 4 exams, 14 chapters, so it's 4, 3, 4, 3 on those exams. There is no cumulative final, so the last exam only covers those last 3 chapters. All right. So differential analysis and product pricing. For some of you, if you have taken economics or are taking economics, some of what we'll talk about in this chapter as it relates to differential analysis may sound familiar to you from the economic analysis that you do in those classes, in macro and microeconomics. So we'll be talking about what types of costs are relevant for our decision making. So as you know, this entire semester, we've been focusing on the internal or management or managerial decision making, how to run our company more efficiently, more profitably, at less cost. How do we optimize our sales, minimize our costs? And so we'll be talking specifically at the beginning of this chapter, which types of costs are important for inclusion and which ones should we ignore because they're not relevant to our decision making. We'll then be talking about how do we set the selling price of a product, looking at the product cost. So since chapter 15, we've been talking about what goes into the cost of a product. So we started out with the very basics, the direct costs of materials, labor, manufacturing overhead. We spent several chapters talking about different ways of allocating support department costs, looking at absorption versus variable costing, all those different approaches that we have learned in the last several chapters. Excuse me. And so in this chapter, we'll talk about, okay, now we know what the costs are. How do we set the price? We'll be talking about bottlenecks and yield pricing for a service business, as is frequently the case at the end of the chapter. We'll be talking about, okay, yeah, but not all companies are manufacturing, so can we even use these techniques, this stuff, in other types of organization? Excuse me. So let's get going. As I said, if you've taken economics, some of what we're about to talk about should sound familiar to you. And in accounting, when we refer to differential analysis, another way or another term for that is incremental analysis or marginal analysis. And so economics, the term that we more typically use is marginal analysis. So what we're really looking at, if you think about the margin of a piece of paper is the edge, right? What we're looking at is the edge of our decision making. In other words, what's different or what will change? If we make this decision, what will be different than what we are doing now? And so ideally, in the analysis that we do, we only want to look at what is different. Unfortunately, some of the exercises that we do, they include some of the information that is not different between our two options. And as we go through those, I'll talk about why we might do that. But in general, it allows us to see our options better if we only look at what would change, what would be different. We have option A, option B, what would be different between these two options. So anything that's the same, we should leave it out of our analysis, because that allows us to more easily, more readily see what are the advantages and disadvantages of these various options. We will also generally take a simplifying approach, which is we look at just two options. So in economics, you might be familiar with the term opportunity cost. What do we give up if we do option A? What can't we give up option B? We're only looking at the next best option. Well, that's not necessarily the way decision making starts out. A good practice is when you have a decision to make, you start out with what are all the options? Let's just be as creative as possible and brainstorm, and just without any kind of judgment or trying to put numbers on it, let's just kind of make a laundry list of all the different options we have here. And once we've done that brainstorming, then we can look at the options and say, some of these are just not possible. Either they're not feasible for our company, or they don't fit in with the general, the overall approach of our company, or they are clearly not going to be the best option of the ones on the list. And so we start narrowing down that brainstorm list to say, what are our best options from this list? Now we've really given it some thought. We've surveyed, maybe we have not a focus group, that's a little too broad, but we asked all of the participants in that decision-making process within our organization, what do you think? What ideas do you have? Because we don't want to keep our focus so narrow. Here's what we're doing now. Let's just talk about a little tiny change we could make to that. We want to be really open about possibilities when we have a choice to make. What are all the options? But then we start narrowing it down. And for our purposes, for these exercises, our decision will already have been narrowed down to what we believe to be the best two options. Two options, either one of which will work for the purpose of the company, but we're going to look at which one is the most profitable or the best decision, the most efficient for our company. The analysis we'll be doing then, the differential analysis, is looking at, as the word implies, it's the root of the word. We're looking at differences between those two approaches or those two options, what we have already narrowed down to be the best two options. We will be accounting for or reporting on how would our revenue be different. In some of our circumstances, in some of our options, the revenues may not be different at all. And if the revenues are the same between the two options, we don't even include that in our analysis. It's not because there are no revenues, but it's because the revenues aren't going to help us make a decision between these two options. Then we'll be looking at the differential cost, the direct costs associated with the two different options, the two different approaches to solving this problem, whatever it is. And again, costs that are the same between the two, we're going to discount or leave out of the analysis. The more numbers we stick into the analysis that don't help us make a decision, the harder it is for us to see the optimal decision for the company. So we really want to narrow this down typically to only the dollars and cents that are different between the two options, the two approaches to solving this problem. Does that make sense? The bottom line then of our analysis, and you'll see this in many of the exercises we do, the bottom line of the analysis will be, what's the profit from option A? What's the profit from option B? Which one is better? Now, it may come down to both of the options actually yield a loss. And so, of course, we'd be looking for the one that is the least costly for us. And if you're thinking, well, why would you do a project that's going to cost you more than it brings in? I'm just going to give you a very quick example. This is several years ago now, but some of you who live in the Olean area may remember this. About 2 streets over from where we are, maybe 3, from where we are right now on the Olean campus is a bakery. It used to be Stroman's Bakery. It's now Bimbo. And Stroman's, when it was Stroman's, you could always tell when they were baking because you could smell the fresh bread baking. And looking at the guys in the classroom, because I know you both live in the Olean area. Do you remember that when you could? And so in the classroom here, I'd be able to smell the bread. And it smelled really good. And I don't even eat bread, but it smells really good. And so that was kind of like a selling point for them, right? People, oh, I should go buy some, that smells really good. I think I'll go buy some bread. And it's Stroman's bread. So, I should probably buy Stroman's because that's what I'm smelling. Several years ago now, a law was passed that required them to reduce the particulate that they were allowing to escape into the air. And so I'm sure not the technical term for it, but they had to install scrubbers on their what I'm going to call exhaust. I'm just drawing a blank on words this morning. So they had to install equipment that would reduce how much they were putting out into the air. And guess what? We can't smell the bread baking anymore over here on campus. Did that increase the profitability of Stroman's? No. Did it increase the bottom line on their income statement? Definitely not. Why did they do it then? Because the law said they had to. And they were avoiding a worse circumstance, having to pay the fine, maybe some bad publicity, by taking that step of reducing how much they were allowing to be released from their plant. So not every decision, in case you're wondering, why is she telling that story again? Not every decision is going to yield a more profitable income statement for us. But in that particular example, it did save them money. They made a conscious decision. It's going to be cheaper for us to install that than it is to pay the fine. And in case you're thinking that companies always are going to take the option that says, we're going to do what the law says, and so we avoid the fine, I'll just give you one more example. If you walk around Olean a lot, and I apologize for all the references being Olean, but that's where I live and that's what I'm familiar with. Just down the street from us, there is a railroad crossing. And I can tell you from personal experience that when there's a lot of snow, the railroad crossings are not cleared. The sidewalks are not cleared. And the law says they have to be cleared, and who's responsible? The owners of the property. That would be the railroad. The railroad has made a decision that it's cheaper for them to pay any fines that come out of that than it is to send a crew out to clear the sidewalk every time it snows. And so for people who like to walk because you don't have a car, you don't have a choice, or you just know it's good for you, you know which places frequently don't have their snow cleared. And the railroad is one of the worst offenders. They don't have a local presence. To send someone out to clear the snow is not cost effective for them. So they have made the decision that if they get fined, they just pay the fine. There are some companies, some businesses that do a fantastic job of keeping their sidewalks cleared, like John Ash Cleaners. They're really, really good at it. They're out there while it's still snowing. It feels like cleaning off the sidewalk in front of their business. Some other businesses are not very good at it. Friendly, not very good at clearing their sidewalks. So, any questions about where we are at this point? So we're going to be setting up for each of these, our first several examples is going to be a differential analysis scenario where we have two options. We've already done that brainstorming. We've narrowed it down to our best two options. And now we're going to do the financial analysis to determine which one is the better option for us and to bring it all back together. And sometimes that doesn't mean increasing our profits. Sometimes it means not losing quite as much money, not costing us quite as much as the other option. All right, I'm going to just show you quickly a very simple version of what we will be doing. So we'll be listing, if they are different, we will be listing revenues and costs for each one of the two alternatives. And then we will have a third column that says, and here's the difference between those two. We need to be careful about the labeling on that third column. If it could be that we say, okay, what's the differential effect for tables, or what's the differential effect for salad bar? The dollar amounts are going to be the same in absolute terms, but the negatives and positives would be reversed. And as always for our template, when it could be a negative or a positive, we need to be careful that we are using the correct one so that we make the appropriate decision about which of these two alternatives we should undertake. So let's go to our first exercise. Differential analysis for a lease or buy decision. So I was just reading the other day an article about Southwest Airlines. Don't ask why I was reading it. And just out of curiosity, and it relates to this lease or buy decision. And several years ago, Southwest Airlines must have been facing a cash crunch. I'm not exactly sure of the backdrop of that, but they took their, at the time, I think they were flying some 737s. Mostly their fleet is 727s, but they had some 737s in their fleet I believe was the plane. And they made the decision to sell those airplanes and then lease them back from the entity to which they sold them. So they owned the planes and they said, we're not going to own these anymore. We're going to sell them, get that cash inflow from the sale. And then we're never actually going to give up control of those aircraft. We're still going to use them, but we're going to make the annual lease payment to the company who now owns them. Very interesting situation. Southwest made the determination that owning the planes was not in their financial best interest at that time. And so they sold the planes, continued to operate them, and then paid someone else. This would be kind of like you own your house, you sell the house to someone else, but you keep living there and paying rent. So the decision was made. They needed the cash inflow. They didn't want to be the owner of those planes. And that's really kind of the decision that's being made in this exercise. Laredo Corporation needs some new equipment, and it has to decide, are we better off if we own the equipment, or are we better off to lease it? You may have yourself made a similar decision about a vehicle, about a car. Is it better to own it, or is it better to lease it? That's exactly what this company is deciding here. So the equipment can be purchased from an overseas supplier for $120,000. The freight and installation costs for the equipment are $1,500. If purchased, annual repairs and maintenance are estimated to be $2,200 per year over the 6-year useful life of the equipment. Alternatively, Laredo can lease the equipment from a domestic supplier for $25,000 per year for 6 years with no additional costs. Now, I need to make one comment here. One thing we are not taking into account in this chapter, but we will, let me just check the chapter number. Yep, so we will in the very next chapter be taking another approach to this type of exercise, this type of decision making. What we are not doing in this chapter is taking into account the time value of money. So that should sound familiar from, if from no other place, from chapter 11 when we talked about corporate bonds. We talked about finding the present value of future cash flows. We use those tables to do that, the present value tables. Hopefully that sounds familiar. In this exercise, we are assuming that the time value of money is not a factor in our decision making. But what I'm going to suggest is it actually is a factor, or it should be a factor. Normally, in a short-term decision making, we can ignore the time value of money because there isn't enough time for that to make a significant impact on our decision making. However, if you give me the choice of spending $120,000 today or spending, just as an example, $120,000 over the next 6 years, I'm going to take the $120,000 over the next 6 years to put off making those payments. It's the same amount in total, but there's value to me to have the money now. If nothing else, it can be sitting in the bank earning what, 0.25% interest or something like that. So it is a little bit misleading that in this exercise, we're talking about a 6-year period, 6-year useful life of this equipment, and we are not taking into account the time value of money. If you recognize that, I would just tell you, we'll deal with that time value of money piece in the next chapter when we talk about capital decision making. This really is a capital decision because this equipment is going to be used by us for 6 years. I would prefer that there was either a closer match in the time frame that these cash flows are taking place, or that we took into account the time value of money, or that the time period was not as long as 6 years. I'm asking you, just for the sake of this chapter, to disregard that, even though it really could have an impact on our ultimate decision. So we need to just disregard that for now, and know that in the next chapter, we will revisit that concept of $1 today versus $1 a year from now. If you're given a choice, you'd rather have the $1 today than have to wait wait a year to get that $1. And hopefully everybody sees that. But for the purpose of this chapter only, we are going to pretend that there is no time value of money, and we're going to treat a cash flow today the same as a cash flow 6 years from now, which is really not valid. But as with many other things, it simplifies our decision making, excuse me, just for this chapter. Any questions about that, about what I just said? Does that make sense? So just pretend with me for this chapter, and after the break, we'll revisit that idea of the time value of money. We will review what we did in chapter 11, which for most of you was probably like November of last year. So it's been quite a while since we talked about that. So we've walked through all of the different costs and expenses related to this equipment. What did we not hear? We didn't hear anything in there about revenues. Well, the assumption is if Laredo Corporation is going to buy this equipment, the revenues aren't different based on whether they lease it or they purchase it outright. So it's not to say that this equipment is not going to help us make money. There would probably be no point in buying the equipment if it wasn't going to help us make money. But we'll make exactly the same amount of money revenue-wise, whether we buy it or lease it. And that kind of makes sense. I think we're talking about exactly the same piece of equipment here. The question is just, how do we finance that? Okay. So let's go ahead to our analysis. We're asked to prepare a differential analysis. You can see the two alternatives, and the third column is going to be in favor of alternative 2. So if alternative 2 is a better option, we're going to show that as a positive value. And if it is a worse option, we are going to show it as a negative value. So we have lease equipment, buy equipment. Well, and it does say if an amount is 0, enter 0. So frequently we are told if it doesn't need an entry, leave it blank. But for this analysis, if the cost associated is 0, we're just going to actually enter the 0. So if we lease the equipment, there is no relevant purchase price, right? If we buy the equipment, it's going to cost us $120,000. Now, as I already pointed out, this analysis includes only costs. If this analysis included both costs and revenues, we would probably show the revenues as a positive, cash inflow, and the expense or the cost as a negative or a cash outflow. For this particular example, it does not matter whether we use negatives or positives when we're talking about only cash flows. So alternative 2 would cost $120,000 more than alternative 1. Again, we're showing that now as a positive because we showed this as a positive. We know that we're talking about costs here. Let's go ahead to the freight and installation. Again, if we lease the equipment, we don't have to pay the freight and installation costs because we don't own it. And so the company from whom we would be leasing would handle all of that for us. They're going to bring the equipment in, they're going to install it and have it ready to go. The only thing we have to pay if we do the lease is the annual lease payment. So freight and installation, we are told would cost $1,500. And so we're going to add that to the cost of alternative 2. Again, repair and maintenance. We don't have to pay repair and maintenance if we lease the equipment. If we purchase the equipment, it's an annual expectation of $2,200 a year over the 6 years. And so because we're given that as an annual amount, we need to multiply by 6. And again, that's a cost for alternative 2 and not for alternative 1. If we lease, then there's no cost under buy, but under lease, $25,000 a year for 6 years would be $150,000. And that's a cost savings for the buy alternative. So we can go ahead and add those up. And so the difference is $15,300 when we ignore or disregard the time value of money. And we treat a cash flow in year 6 the same as a cash flow at the beginning of year 1. What would our decision be? We would buy the equipment. It saves us money. I am skeptical that we would make that same decision if we took into account the time value of money. Because again, the full $120,000 needs to be paid up front. The lease is $25,000 a year over 6 years. 6 years from now, the $25,000 payment is likely to be worth significantly less in today's dollars. And so I would really be concerned if we did not take into account the time value of money in this circumstance. But it's what we're doing for this chapter, and I've asked you to just be patient about that. So, any questions about what we did in this exercise? Very typical scenario that a company might be deciding. What did we not take into account here? What was the assumption we made? The assumption we made was that the company has the $120,000 available right now to buy that equipment, because we didn't talk anything in here about financing. Do we have to borrow that money? If we have to borrow the money to buy that equipment, we also would need to include in here the cost of financing. That for the lease, we only have to come up with $25,000 at the beginning, not $120,000. And so I just want you to be thinking about all of the other factors that might not be included. Again, for our exercise, we can only include what the software, what the problem has given us. But in reality, there's much more behind that, much more to it. Okay, anybody questions at this point? Let's keep going then. As I said, we're going to be going through in these exercises, the next several exercises, differential analysis for different types of situations that are very typical or common for companies to need to consider. And so in this exercise, we are looking at a discontinued product. A condensed income statement by product line for Warwick Beverage Incorporated indicated the following for Mango Cola for the past year. And so they look at this and they say, ooh, when we separate things out, when we look at just the information for Mango Cola, it appears that Mango is contributing an operating loss of $3.8 million. And so if we just look at the face of it, it seems like a no-brainer. We're losing money on Mango Cola. We should stop making that product. But there are other considerations here, and that's what we're going to be looking at next. It is estimated that 30% of the cost of goods sold represents fixed factory overhead cost, and 25% of the operating expenses are fixed. Because Mango Cola is only one of many products, the fixed cost will not be materially affected if the product is discontinued. In other words, if we discontinue the product, 30% of this cost is simply going to be allocated to other existing product lines. And 25% of this is going to be simply shifted to other product lines. Again, if you've taken economics, microeconomics, this is something that may sound familiar to you. And we addressed it starting in the CVP analysis chapter when we talked about contribution margin. That really a decision may come down to, does it cover the variable cost? In microeconomics, when you talk about the cost of production and you talk about the shutdown point is when your losses would exceed the fixed costs. And that's what we're going to be checking in the differential analysis for Mango Cola here in this exercise. If we continue it, everything stays the same. So this is one of those exercises that I would suggest we're not only looking at the differential costs. And the reason we do this here is because, think about it, if you're working for this company, this column is what you're used to seeing. We want to see, what do we have? What does Mango Cola look like? We want to be reminded, why are we even having this conversation? Because continuing Mango Cola is contributing a $3.8 million operating loss to the company. We want to keep that in mind. And so our first column here, and you can go ahead and do this if you haven't already, the first column is going to include the same information, except we are going to put this into what we, in the CVP analysis chapter, referred to as the contribution margin income statement format. So we're splitting out the variable from the fixed costs. The revenues are unaffected. If we keep it, we don't expect to sell any more or any less of it. The profit or loss, the bottom line, is exactly the same, but what is going to change is how we split up those costs. So we start with our cost of goods sold, and we want now just the variable cost of goods sold. So it's $10,800,000 is the total cost of goods sold, direct materials, direct labor, and overhead. But 30% of that is fixed factory overhead. So that means 70% of that total is variable. That would include direct materials, direct labor, and the variable overhead. So $10,800,000, 70% of that would be the variable cost. And as I indicated in the previous exercise, now that we are including revenues and expenses, we want to show the revenues as a positive number, the expenses as a negative number, and it does tell us to use a minus sign to indicate a loss. Now we look to our operating expenses, and we're told that 25% of those operating expenses are fixed, which means 75% is variable. And now there are any number of ways that you can get to that fixed cost total. You can go back and calculate 30% of the cost of goods sold and add that to 25% of the operating expenses. You can take the total expenses and subtract what we already know. You can back into the number by looking at the rest of this equation. And I don't care how you choose to do it. I will show you one way on the screen, just in case you're unsure. And probably the most direct way to do it is to go back to our original calculations. So 30% of the cost of goods sold is fixed factory overhead, and we're going to add to that 25% of the operating expenses. So go ahead and do your calculation. You can use the same formula that I just put on the screen, or you can do it one of the other ways that I already suggested. And so again, for those of you who, any questions about where that number came from? You may not have gotten to it the same way I did, and that's fine. There are other, I think I listed 3 other perfectly legitimate ways of finding that number. But again, we've just taken the information that we're already accustomed to seeing if we work for this company, and we've simply broken out the part that is fixed. Because in the traditional approach, the multi-step approach to the income statement that we have here, that we learned back in chapter 5, we can't see, it's hidden how much of this cost might be fixed. And so by breaking it out like this already, especially if you've taken economics, you're looking at this going, yeah, but they obviously had a positive contribution margin. In other words, their revenues more than covered their variable costs for producing that product. And so if we completely discontinue Mango Cola, these fixed costs do not go away. Fixed costs do not go away. We're told that. They just have to be absorbed by the other products that we are still going to be producing. And so what does go away? No revenues, no variable costs. So the no variable cost is a good thing, but the no revenues, not so much. And so what we see, because this product does have a positive contribution margin, because each unit we sell covers its variable cost and then some, this company's not at the shutdown point. By producing Mango Cola, even though it's at a loss, the loss would be greater if we stop producing it, because it does cover some of those fixed costs. And if we eliminate it, those fixed costs don't go away, but they need to be absorbed by the other products that we produce. And so our labeling on this column says, what does it look like for alternative 2? Well, we lose 15 million in revenues. We save 7,560,000 in variable costs, cost of goods sold. We save 6 million, not 60 million. Carried away with my zeros. We save $6 million. Fixed costs, exactly the same. No difference between the 2 alternatives. And so the bottom line, and you can find this either by finding the difference between the loss for each alternative, or by simply adding down the far right column. And so what you see is what we already knew was going to be the case. The fixed costs exceed the loss. When we produce Mango Cola, at least it's covering some of those fixed costs. And so our decision would be, should it be retained? Yes, because less of a loss is better. Now, does that mean, we finished the exercise, but I want you to think about this. What does this really mean to us? Well, if you are this company, Warwick Beverage Incorporated, if you are Warwick Beverage Incorporated, does that mean that you have to just go about your business, do absolutely nothing, and just deal with the $3.8 million loss associated with Mango Cola? No. This decision is being made in the short term. In the short term, we have decided, we have calculated, it doesn't make sense to discontinue it because our loss would be even greater without Mango Cola, because it does have a positive contribution margin, because it does help us cover some of those fixed costs. But in the long run, we're looking for, okay, but what can we do about this? It still is a fact that we aren't making money on Mango Cola. So what do we do about this? Well, there's a couple different options. I'm just going to throw a couple of ideas out there. Maybe we start marketing it differently. Maybe we find a different niche for it. Maybe we find some other goji berry cola and kind of shift that in so we can phase mango out and goji or something else in its place that would continue to absorb those fixed costs, but at the same time, maybe be a little bit more profitable. Maybe we can increase our sales. Maybe we can sell more than $15 million of goji soda.
So it also seems like the alternative to discontinue means that they aren't doing anything with that production. I mean, isn't
Right.
there, couldn't they switch it to like one of their other colas that they have that they
Yeah.
seem to run short of that can use the increased production?
Yeah, so I don't know if you guys on Zoom, I never know if you guys can hear what's being said in the classroom because the microphone is right here in front of me. But the question was, couldn't they shift that excess capacity to one of their existing products? And the answer to that is possibly. So we keep talking about, it's come up in several chapters now, that we should be producing that concept of pull-through production. We should be producing because we can sell it. And so absolutely, if there's some other product that they already produce that they believe they could sell more if they made more, absolutely. And that should be taken into account here. In this exercise, we're only looking at, do we make it or not make it? But absolutely, in the long run, that's part of that decision-making process is maybe we don't need to invent a whole new goji berry cola. Maybe we can increase the sales on our regular cola or cherry cola, whatever. So absolutely. And that might be even more, if they have sales to support that, that would save all the R&D that goes into developing, my goji berry cola that maybe nobody wants to buy that either. So yes, if there was demand that's unmet for a product that they already have, I would absolutely start doing that today. If that product has a better profile, a higher contribution margin than what we're seeing in mango. Maybe they can increase the price of mango. Again, we didn't include that in this analysis, but that's something we could be considering. We're going to be talking about product pricing in a little bit. So yeah, they're definitely, the first step is recognizing we've got a problem here. Mango Cola is not increasing our bottom line to a positive point. We've done the analysis and we realize, yeah, but it is doing something for us. It's covering $1,440,000 worth of fixed costs. So it's not totally pointless. It isn't costing us more to sell it than to not sell it. We've done that. So we know the first step isn't immediately shut down Mango Cola and we don't have to do anything else. We're looking at a long-range plan. How do we get out of this? But again, the first step is recognizing, yeah, it's not totally pointless. It is contributing something. It's just not enough. So yeah, definitely those are options for us. Raising price, shifting that productive capacity, that excess capacity to some other product where we could sell more if we had it. Everybody good so far? Okay, let's move on to our next exercise, and this is a similar exercise, decision to discontinue a product. And when we look at this analysis for Hawkeye shoes, we are actually seeing all three of the different products or product categories. And you can see here that children's shoes is contributing a $30,000 loss. And so when we just look at this, our first reaction is we should just stop making those. Now, what we want to do is a similar analysis to what we did in the last exercise. And because it's very similar, I'm going to ask you to try this on your own. I'm going to pause the recording and ask you to work on this independently. Once you have completed, if you're watching on the recording, once you've completed this section and answered the questions in part B, restart the recording. Okay. So this one was a little easier in terms of the presentation because the original already had the variable and fixed costs separated for us. What it did not say and should have is that if they discontinued children's shoes, those fixed costs would not be changed. They told us that explicitly in the previous exercise, and they really should have done that here as well, because some of those fixed costs could have gone away. It could have been associated specifically with the children's shoes, and so they could have been divested, but it doesn't tell us that. We're assuming that that's not the case. We're assuming that those fixed costs that right now are being absorbed in the children's shoe line would be shifted to the men's and women's shoes as opposed to going. So our decision then, because the manager isn't looking at only what would change, which is only the variable costs and revenues, that manager misses that the fixed costs are being in part defrayed by the children's shoes, by the contribution margin from the children's shoes. And so if those fixed costs had to be shifted in their entirety to the other two product lines, our loss would actually be even greater, would increase by $45,000. Any questions on that? Again, a very common misconception. You know, we look at this income statement by product line, and it looks like children's shoes are the problem here. And so how do we make it better? We get rid of the children's shoes. But we disregard that some of these costs may not go away. Now, again, it doesn't mean they have to continue making children's shoes forever. However, we'd want to be looking for what can change. How can we better use that capacity or better market our children's shoes? Maybe the children's shoes price could be increased. I don't know that, but it's something to look at. Another possibility that's not included here is right now this store, Hawkeye Shoes, sells men's, women's, and children's shoes. So let's think about this from the perspective of a parent who might want to buy shoes for themselves as well as for their children, and one-stop shopping is what they want. And so if we discontinue children's shoes, it could also have a negative impact on the selling of men's shoes or women's shoes. And so we need to keep that in mind. We need to know the answer to those questions before, even if this analysis, the way we did it, had said, yes, go ahead and discontinue children's shoes because they aren't even covering some of their fixed costs. They aren't even covering all their variable costs. We'd still need to keep in mind the impact of discontinuing one of our segments. Does that impact the other segment? And maybe it doesn't, I don't know. But I can absolutely see a circumstance, thinking about being a busy parent and you just really need to go buy shoes. You want to do it all in one place.
I saw with it is that they're spending, out of all three categories, they're spending the most in selling and administrative, but they're bringing in the lease and sales for the thing that costs the lease and costs the sold.
Yeah, good point. So what Drew just said here in the classroom is that in the children's shoes, their variable selling expenses are higher than either of the other two lines.
Well, their total selling and administrative are higher than both.
Yeah, and it's hard to know how these are allocated. So I don't know, it could be that the allocation base that they chose just automatically assigned more to children's because they have more variable. I don't know. So I'm more interested in this, which is considered controllable. So why are they spending so much on selling and administrative expenses on the children's shoes that it totally wipes out the gross profit? I don't know. I don't know the answer to that. It's kind of weird. Do they have to advertise more? Do they have to pay people a higher commission on the children's shoes? I don't know what the answer to that is. But yeah, that's a very interesting observation.
Get my money's worth out of selling and administrative expenses, or start saving some money there.
Yeah. So lots of different alternatives, and that is absolutely a reasonable approach to take, to say, is there something else in here we can change? And one place to target certainly would be those variable costs. And of course, you'd go to the ones that seem to be abnormally high. Why are we spending so much on the variable selling and administrative expenses for children's shoes? I have no idea why that would be the case, but it's certainly something that should be examined. Good catch. Okay. Any other questions or comments before we move on? Our next exercise actually deals with a service company. And so what you'll notice is we have a list of costs and expenses. None of these is a manufacturing or a product cost. So as we do in most chapters, we want to see how this approach can be used by other non-manufacturing companies as well. We're looking at only costs here. So the assumption is that the decision that we are making here will not impact our revenues. It doesn't mean that there are no revenues, but it means that the decision we are making would not change the revenues. It's not a differential revenue. There are not differential revenues between our two alternatives. Again, a very typical decision to be made by any company. Should we do it in-house or should we outsource it? This could be applied in any number of areas. Many companies make decisions, for example, about how to handle their human resources, how to handle their payroll. Do we do it in-house? Do we do it outside? outsource it. That's exactly what's being considered here is we have a function that we currently do in-house. Would we be better off if we just got someone else to do it? Theater Arts Guild of Dallas, Tag D, employs 5 people in its publication department. These people lay out pages for pamphlets, brochures, magazines, and other publications for the Tag D productions. The pages are delivered to an outside company for printing. So they're already outsourcing the printing, but they're putting together the brochures or the pamphlets inside. Excuse me. The company is considering an outside publication service for that layout work that they currently do in-house. The outside service is quoting a price of $13 per layout page. The budget for the publication department for the current year is as follows. Total of $372,000, and that's for 24,000 pages. The publication department office space and equipment would be used for future administrative needs if the department's function were purchased from the outside. So what we're being told is that the space and equipment would stay the same. The space and equipment would stay the same. Actually, it might be just the office depreciation and the computer depreciation. We're going to hold on to that. Right now, we don't have anything else planned for it, but we're just going to hold on to it in case we want to use it or need to use it in the future for something else. So the office depreciation and computer depreciation, we're being told, that's what they're telling us here, is those are not differential. So as we look down here, the office depreciation and computer depreciation, I'm just going to put zeros in there right now because we're not even considering that in our calculation, in our analysis. And do not ask me why they didn't put boxes under column 1 here to lay out the pages internally. I don't know, seems kind of weird to put them there. In my world, if I had done this, I would have just left those lines out altogether. So I assume that they put them into the template here just to make sure that we have that thought process or that conversation about, is this really different? But in reality, these 2 lines could be just omitted altogether. We only want to include those costs and revenues that are different between the 2 alternatives. We could have put in both dollar amounts. What were the dollar amounts now? $28,000 for office depreciation, $24,000 for computer depreciation. We could have put those in both column 1 and column 2, or under alternative 1 and 2, because they're the same. And then have the 0 over in the far right column. But again, it doesn't help us make a decision. And so why put those numbers in there to distract us from the content, the analysis that really is different between the 2 alternatives? So if I had done this, I would have just left those rows out altogether. It's not going to help us make a decision. Now, one more comment and then we'll get to work on this. Do I think that's a good idea for them to just keep the office space and equipment in case we need it later? Maybe not. There's a concept, and I hate to keep coming back to economics because I know that not all of you have taken economics. But there's a concept in economics known as a sunk cost. Sunk cost. A sunk cost is a cost that is based on a decision that has already been made in the past and cannot be changed now. These are depreciation, whoops. These 2 final expenses here are both listed as depreciation. As you know, depreciation is a non-cash expense. In other words, Nobody's sending us a bill for $28,000 a year for office depreciation. Yes, it does show up on our income statement as an expense, and it does decrease our operating income for this organization. But there's no cash involved. So the tag G may be thinking, well, we already own the equipment, we already own the office, and we're not paying that, what, $52,000 in depreciation. We're not paying that every month or every year, excuse me. We're not paying that every year, so we can just hold on to it. We already own it. What's the difference? And here's my suggestion. There's another concept, and I've actually used this term earlier in class today, opportunity cost. An opportunity cost is, what else could we be doing with that? So by making the decision that we're going to keep the office space and the equipment just in case, because we already own it, so why not? We don't have an annual bill for that depreciation. It doesn't show up on our cash flow statement because nobody's sending us a bill. But what is the opportunity cost here? Well, what other option do they have? If they choose not to keep the computer or computers, what else could they do with it? Sell it, maybe? I don't know, it's a super expensive computer system they have there. If they're recording $24,000 in depreciation a year, it's only 5 people. So what do they have here to do these layouts? They're not even doing the printing, remember. They're only doing the layouts with this. Sounds like some super high-end equipment. And so maybe they could sell that equipment. And the cash flow from that would offset it. I know it's only 1 year, one-time deal, but the selling that would offset some of the cost of outsourcing this. So that's an opportunity cost. They give up the opportunity to sell that equipment when they make the decision to just keep it and maybe not be using it or not be using it right away. What about the office space? Well, I'm assuming that I'm picturing in my head, this is a building, maybe they own the building and the layouts are only done in one room or one area of the building. But by making the decision that they're going to not use that office space for some other purpose, they're giving up the opportunity maybe to increase their revenues. Maybe there's something else they could be doing, selling merchandise. I don't know, just throwing ideas out there. Selling merchandise. Maybe they turn it into a little coffee shop or a gift shop for theater attendees. Maybe they can lease that space to another entity that has some kind of a connection to maybe enhance the whole Tag D experience. Again, I don't know what that would be, but by saying we're just going to hold on to it, we give up that opportunity to do something else with it. And that may be not out of pocket costing us money. It's not an explicit cost, but it's an implicit cost, an opportunity cost, because they've given up the opportunity to use those computers and to use that space for something else that might contribute to their bottom line. So again, we're not asked to consider that for this exercise, but I think it's important for you to be considering that on your own. What else should this company be looking at? So for laying out the pages internally, the salaries, benefits, supplies, and office expenses we're saying would be exactly the same as what we're paying right now. And if we purchase those services from an outside entity, we would not have that expense. And so for each one of these, remember, I already pointed this out, there are no revenues here. So when we are showing these values as positive, that means that it is an expense. If there were revenues here, we'd want to make sure we show those expenses as negatives. And so if we purchase the layout services outside, we save that $224,000 in salaries. And we're also paying those workers benefits, costing us $36,000. We would not need to pay those. We are spending 21,000 on supplies that we would not need to spend. And the office expenses, 39,000. We can go ahead and calculate the total of laying out the pages internally, not counting the depreciation on the office and the computer, because those are not a difference between the two alternatives. And so we're going to compare the total cost of $320,000 for laying out the pages internally with the cost of outsourcing them. And it's 24,000 pages at $13 per page. Oops. Here. And so what we learn is that as long as we want to keep the computer in the office and not do anything else with it, sell it, lease it, put in some other revenue producing part of the business in that office space, we would actually save money. We would save $8,000 to have those layout services done outside. I think it wouldn't take much for us to use that space or sell the computers or both and make the results of this be a whole different ballgame, a whole different scenario. Let's go ahead and answer the questions for B and C. The benefit from using an outside service is shown to be greater than performing the layout work internally. The fixed costs in the budget, which is the depreciation expenses, are irrelevant to the decision, although we've just gone through why that might not be the case. But given what we have here, because they are not differential, because the company TAG D has made the decision, we're not going to do anything with that, we're not going to consider them in our decision. Thus, the work should be purchased from the outside on a strictly financial basis. However, before electing to lay off the 5 employees, the TAG D should consider the long-run impact of the decision. So do they really want to lay off those employees? There's always that personnel question. Could they have those employees do something else that might be more meaningful, more profitable, or better for the bottom line? One other consideration, and then we'll move on to our final exercise for today. One other consideration. We are paying by the page if we outsource this. So where's our break-even point? $8,000 more. $8,000 more at $13 a page is about 615 more pages. When we're talking about 24,000 pages that we expect to lay out this year, what if it was 24,615? On the 24,616th page, our decision would be different. And so part of this, as it says, consider the long run impact, part of this is, I don't know, what's the chances that we have to lay out more than 24,000 pages? And as soon as we do that, that's an increase of about 2.5% over the pages we're currently producing. So we need to consider if our production rises by 2.5%, is that something that would still be done within this same $372,000 budget? Or would some of these costs go up? Could the 5 people we currently employ do that? Is it in our, do we have excess capacity? Because that's definitely a consideration. If we're a growing entity, if we think we might be producing more pamphlets, brochures, magazines, and other publications, a 2.5% increase might be within our plans, certainly within our possibility. And so do these 5 people have excess capacity? Because all of the cost, if we outsource it, all of the cost is variable. And so that's another consideration. Last exercise for today. Any questions before we move on? No. In this exercise, we're actually going to take into account the opportunity cost, or what else could we do with this machine? Exercise 5 is a machine replacement decision. Again, something that routinely companies are faced with. When do we replace our old equipment? When does it become more efficient to pay the extra money? And so I've already talked about the concept of sunk costs, something that's based on a decision that was made in the past and it's too late to change that. Even if the decision was made last year, we can't go back and unmake that decision. I'll give you a very quick example. Again, I'm stuck here in Olean with my examples because that's what I know. Not too far away from the college, down the street, and make a right, just behind the St. Mary's Basilica here in Olean, there is what used to be a school, and it was called Ivers J. Norton. And it is now a church center. And as the Olean School Board was making a decision about what to do with that school, there was a smaller and smaller population of school-age children, particularly in that neighborhood. And Olean was moving away from having an elementary school in each neighborhood because they just weren't needed because of the population decline in the area. And I actually listened to people talk and read in the paper people's discussions. It doesn't affect me because I don't live in Olean, I don't pay taxes in Olean. But I thought from an economic standpoint, it was a very interesting discussion because this is what I heard. Well, we can't sell that school. We just upgraded all the electric and we rewired the whole school last year and put in all of the, I don't know, Wi-Fi or whatever they did. And so we can't sell the school now. And my economics hat said, but you already did that. Doesn't matter that you did that last year. It's too late to undo it, to not do it. Sure, you can say, I guess we shouldn't have done that last year. But the fact that you did that last year is not a reason to change your decision about what do we do now. And eventually, they did make the, I assume, correct financial decision to close that school and sell it because it wasn't needed. And it didn't matter that they had just redone all the electric or the whatever wiring they did. Can't really remember now. Some kind of wiring, they just did the whole school. And people were saying, well, yeah, but we did that last year. We need to keep the building. And that really was not part of the decision-making process. Shouldn't have been from an economic standpoint. Still hard to put that aside. One more quick example. In this one, maybe you can relate to a little more. When you buy a ticket to something and you can't do anything else with the ticket, you either use it or don't use it, your decision should never be based on, but I paid for the ticket. Because you already paid for it. If you could sell the ticket, that's a consideration. But if you're just stuck with it, the decision then becomes, will I be happier or better off if I do the thing or not do the thing? because it's too late to not buy the ticket. And so sometimes I think people can relate to that better, because there absolutely is an inclination. I paid for the ticket, I need to use it. But that should not be the decision. From an economic standpoint, that really doesn't make sense. It's a sunk cost. And that's what we're looking at in this exercise. The very first sentence says, the company is considering replacing an old piece of machinery, which cost $400,000, has accumulated depreciation of $175,000. So what that means is the book value of that old machinery is $225,000. And what I am telling you is all of that is irrelevant to our decision, because we already bought the machine. We already decided how much depreciation we were going to record each year and how long we were going to use it. The only decision now is, are we better off with the old machine we already have or the new machine, which has a purchase price of $550,000? We could sell the old machine for $250,000. Again, it doesn't matter that what our books say it's worth is $225,000. The annual variable production costs associated with the old machine are estimated to be $72,500 a year. The new machine, only $24,000, much more efficient. So we're assuming that the revenues that are produced by using this equipment for whatever we use it for, making widgets or whatever, we're assuming that that would be the same. But the difference is we could sell the old machine and get $250,000 for it. We could replace it with the new machine and save like $48,000 a year. Is that worth it to pay the extra to get the new machine and save $48,000? As I already suggested, I need you to bear with me for this week only on the time value of money. We are not taking that into account in this chapter. That being said, it is absolutely appropriate to include that in our business decision making, and we will get to that, the concept of time value of money and how it does impact this kind of decision making. We will talk about that after the break. So let's go ahead with our deciding, do we buy the new machine or do we stick with the old machine? If we continue with the old machine, clearly we aren't selling it. And so there would be no revenues there. But if we replace it with a new machine, we get to sell the old one and we get a $250,000 impact of that. It increases our income. Again, it doesn't matter that it has a book value of $25,000 or $225,000. It doesn't matter that on our income statement we would be showing a gain of $25,000 from selling that machine. The only thing that matters here are the things we can change, the things that would be different, and that is we receive a cash inflow, one-time cash inflow at the beginning of the project of $250,000. If we continue with the old machine, we don't have to pay for the new one. But if we replace it, we're going to be paying $550,000 for the new machine. Is the cost savings from basically the trade-in, selling off the old machine plus the 48 and change in operating expenses worth it? Well, our variable production costs $72,500 using the old machine. And that's a cash outflow or an expense. With the new machine, $24,000 for the 8 years, only $192,000. Whoops. And so the difference favors purchasing the new machine by $388,000. Now, one last note about this. we might want to do a sensitivity analysis to think about how we're estimating these new costs to be 24,000. What if it was 30,000? Or at what point would it be the break-even point where we would have been better off to just keep the old machine? To me, it seems kind of crazy that the new machine costs only 1/3 as much. So how sure are we? Is that what the salesman on the new machine told us? Or have we talked to other businesses who are using the same machine and are reinforcing, yeah, it's really only 24,000 a year? How sensitive are we? How sensitive is this analysis to the possibility that that number is wrong? At this point, we come out to the good by $88,000. But that's over 8 years. That's $11,000 a year. How sure are we that the actual operating costs of this new machine aren't $35,000? Still a huge savings. Sounds like a great deal, but at that point, we'd be indifferent to whether we keep the old machine or sell it and get the new machine. So based on this, we definitely would replace the old machine. And in this analysis, the sunk cost, what we did not consider is the book value of the old machine. 400,000 minus the 175. The sunk cost is the $225,000 book or carrying value that remains on that old machine. So we didn't actually get through half of the chapter in record time, but I would still anticipate on Thursday that we will finish up the chapter in shorter than the full class period for planning purposes. Any questions before we call it a day? I guess we're 2 minutes early. We're not always 2 minutes early. Yes,
Can you scroll back down? I didn't see what the sunk cost was.
the sunk cost is the book value of the old machine, the carrying value of the old machine, the $400,000 minus the accumulated depreciation. And it's a sunk cost. It's determined by decisions we made in the past by that machine. How long are we going to use it? What's the annual depreciation? And so it shouldn't be considered in this analysis because it's too late to change any of that. Any other questions?
Actually, they end up getting actually 25,000 basically, because if they're selling it for 250.
So they would show on their income statement a gain of 25,000. Yes. So, but what's really important here is not that gain, but the cash flow of 250,000. Yeah. All right. Well, if there aren't any questions, we will stop there for today. Thank you for being here, and I will see you on Thursday.